Ladies and gentlemen, good morning. My name is Colin Lawson and I'm the founder here at Equilibrium. Firstly, apologies for our 2-minute delayed start and a few technical issues which hopefully have now all been resolved. So this morning I'd like to introduce you to our company, to tell you all about Equilibrium, about who we are as a business and as a group of individuals, about what we do for our clients, and perhaps most importantly, why we actually do it. What I'm not going to be talking about today is our investment strategy. I'm not going to be talking about tax planning. We have some events coming up that will cover those. So on the 8th of July, we have an introduction to our investment process and also what we've been doing in that regard during COVID and how we see markets developing over the years ahead. And that'll be followed up by a further presentation on inheritance tax and intergenerational planning, although you will be getting a small taste of that today as well. And really today, I just want to tell you a story. I want to tell you about how Equilibrium came into being, about what we're doing today, what we stand for as a business, what we're attempting to do and what we are doing on behalf of our clients. And then tell you as well where we're heading as a business and why you can have confidence that if you do come on board as a client, if you are already a client, then Equilibrium will continue in its current format for many decades to come. And I believe that if you're going to tell a story, then it's always useful to start at the beginning. And so I'm going to start at school. And school and I agreed on one thing and one thing only. I didn't like it and it didn't like me. I'm assuming that these days I'd have lots of lovely labels from dyslexia to ADD, but back then I was just one of those kids that couldn't focus. And unfortunately, the consequence of that was that I left school with very few qualifications. And with very few qualifications, your options are obviously very limited. And so I decided that the armed forces would be a career for me and picked the RAF as my choice. And I passed all of the entrance exams, passed all of the assessments, but unfortunately fell at the final hurdle as I was diagnosed with mild asthma. And so at that point, I really was stuck. But fortunately for me, Margaret Thatcher had introduced a program called the Youth Training Scheme, where you got to go and get work experience and were paid the princely sum of £27.30 a week, a number that I will always remember. And my first role was working with the Automobile Association. Their head office was based in Cheadle-Hulme, and I got to spend 3 months in all of the various different departments, and it was great for gaining that early life experience. And I managed to get myself a real job with the Automobile Association on their motor claims department. And I progressed through from a grade 1 to a grade 3. Each year you could apply for a new grade and you had to be interviewed for that, obviously. And my boss at the time was a grade 20. And it's fair to say that he was very grumpy and pretty overweight as well. And I thought, wow, if I stay here for the next 17 years or so, I can also be as grumpy as you. And so that prospect was not exactly inspiring. And luckily for me, next door, I could see out of my office window, was Norwich Union, what is now Aviva. And I used to watch their consultants driving nice cars, wearing nice suits, and they seemed to spend quite a bit of time in the pub entertaining their IFA connections. And I thought that was a far more appealing role. And so I actually took a pay cut from the AA, joined Norwich Union as an administrator and set my targets on becoming a consultant. And after a number of years, joined their trainee consultant program and eventually moved to another company where I got the opportunity of being what was then called a broker consultant. Broker consultant, of course, is a very nice word for a salesman. It was my job to go and visit other independent financial advisors and promote the products of the company that I was working for at the time. I was living in Bramall. The office I was working out of was in Stoke, and the first area that I was given to look after was North Wales. I was then promoted to Stoke-on-Trent, if that's at all possible, and from there to South Manchester, and eventually from South Manchester to Manchester city centre. And over a number of years, I'd had the experience of seeing IFAs, independent financial advisors, of all different shapes and sizes in different territories and different areas. And one of my conclusions were that they were doing so many things so badly and yet being so successful. And so blessed with the arrogance of youth, as I called it, that I thought that if they're doing so many things so badly and yet doing so well, then how difficult could it actually be? And so I decided to set up from scratch in my back bedroom in Bramall with no clients, no past experience. And it was an interesting few years to start off with, I think it's fair to say. My definition of those first few years is that I was a martini man. I would see anybody, anywhere, about anything. And I had a clear definition for what a new client looked like. These days we have client personas, we know exactly the kind of people that we want to work with. Back then, at a fairly low bar, it was basically breathing. That was pretty much it. And I did that for 2 years, working 14, 16-hour days, and then came to the end of that, and whilst it was pretty successful, I realized that I was making half the level of money that I was when I was employed, and yet working twice the hours. And as I said, I'm no economics graduate, but it wasn't quite the business dream that I had in mind when I first set up the company. And so as always, when things aren't working, I believe that you sit down and do something called blue sky thinking. You sit down and say, okay, what is it that you really want to achieve? And my thoughts were relatively simple. And that is that I'm working within financial services. So surely dealing with people with money would be beneficial. I was frustrated going out in the evening, and so I wanted to see clients during the day. I was frustrated at getting lost trying to find people's homes, and so I thought it'd be great to see people at a location of my choice. And then finally, I decided that it would be great ultimately to build a business so that I'm not just a self-employed freelancer. And the only problem then was at the age of 27, that I didn't know anybody that would fit into those ideal categories. I didn't know any older, wealthier people. And so I went out into the marketplace and looked at who was the most successful in these areas, and came across an individual who was very happy to share his secret sauce with me and explain exactly how he went about doing things. And that was the birth of what we classed as event-based marketing. Normally we do face-to-face seminars, we have lunches afterwards, and they're great events. And this is just another form of event-based marketing that we've had to evolve to over lockdown. And that worked really well for a number of years. It literally did transform the business. But back then it was very much a transactional relationship with the individuals that we were seeing. They would come in, we'd review where they are, we'd make a recommendation for them, and then almost we would send them on their way. It was more of a customer-based relationship rather than a client-based relationship, more transactional than ongoing. And that worked fine until we got to the bursting of the tech bubble in the early 2000s. And it dawned on me that we'd had all of these customers over the years, but that actually we didn't have any firm, long-lasting client relationships. And that actually we hadn't developed a robust investment and tax planning strategy for those clients. As I said, it was more ad hoc, it was more transactional. And I came across this quote from Warren Buffett, and we use it now in almost every presentation that we do, and it actually goes back to 1974. And he says that to invest successfully over a lifetime, and it dawned on me that that's exactly what we want to do for our clients. Not to recommend the flavor of the month product, not to have a transactional relationship, but to make sure that no matter what happens in their lives, in the economic world, in the investment world, that they can say that they've been successful with their investments over their entire lifetime. He goes on to say that it does not require a stratospheric IQ, unusual business insight, or inside information. What I believe he's saying is that actually investment planning is based on some common sense principles. And as long as you stick to those common sense principles, then you can't go too far wrong. He then says what is needed is a sound intellectual framework for making decisions. And that's exactly what our investment process is. It's exactly what our financial planning process is designed to do. And finally, he then says that you need to have the ability to keep emotions from corroding that framework. And of course, when it comes to money, those emotions are fear and greed. Greed that will lead people to making inappropriate risk decisions at inappropriate times, trying to chase those higher returns. Of course, fear is more prevalent right now. And fear can cause anxiety, and it can cause us again to make the wrong decision at the wrong time, perhaps bailing to cash during recent market falls that we've had recently. And so we decided to design a service that combined three key elements. And the first one, and we have to always start here, is financial planning. Because if we don't know what your financial plan is, if we don't know what it is that you need this money to do for you, then how can we actually build the investment plan to deal with that? So financial planning comes first, then we deal with the investment plan and the risk management to make sure that you can tolerate the volatility that is inevitable in the markets that we all invest in. And then finally, we have the tax planning angle, which says that once we've got your financial plan right, once we've got the investment plan right, then how do we stop tax of income tax, capital gains, and inheritance tax from corroding those returns? And the target that we've set for our balanced portfolio is to aim for returns of 5% above inflation over rolling 5-year periods. Some 5-year periods will be less, some 5-year periods will be more, but it's our job to try and narrow that gap as much as possible to get as close to that target as frequently as we can. And that target came about by talking to clients and prospective clients to try and find out what it was that they really wanted their money to achieve for them. And we discovered that it didn't seem to matter whether you had 100,000 or 10 million, that if we could deliver a 5% above inflation return, then that seemed to meet everybody's needs. So if you could have access 5% of your capital for either income or capital expenditure and inflation-proof the balance, then it met everybody's needs. So it dawned on us there was no point in taking more risk than that if that puts that financial plan in jeopardy in the first place. But when you think about it, all of these things are hygiene factors. I'm assuming that you can go onto any financial advisor's website and they will tell you that they do financial planning, investment management, and tax planning. They will, some of them actually, will tell you what their targeted returns are. Many won't, but some will. But they're hygiene factors. They're what you should expect any reasonable financial advisory wealth management firm to deliver for you. But I believe that we're so much more than that. And if you think about how advice has evolved over the 25 years that I've been in the advice business, originally the salesman was king. Some of you may remember companies like Allied Dunbar that were nicknamed Allied Crowbar for their very hard sales tactics. It was all about product selling. It then evolved as we moved through the retail distribution review, that it seemed to be that the person that had the most technical knowledge was the right and best advisor to work with. And while sales skills are important, we still need to persuade people sometimes to do things that they don't necessarily instantly want to do. And whilst technical skills are obviously of key importance as well, I think the real added value comes from coaching. And coaching is nudging people to do the right thing. It's helping them make the most of their money. When you think about it, it's not about making the most money possible, although obviously it's important. What's really important is helping people to make the most of the money that they've already accumulated while still trying to make it grow into the future. And a great example of the coaching that we do is in relation to our inheritance tax and intergenerational service. And when you think about inheritance tax, then I class it as preparing the kids for the money. It's all about data, it's all about numbers, and it's a bit dull and boring. But intergenerational planning, on the other hand, is very different. Intergenerational planning is preparing the kids for the money. It's making sure that the right people get the right amount of money at the right time. And often it's very values-based. And when we think about it, we are all the product of our experiences. And our experiences come from two key areas. They come from the world that we live in, and they come from the people that we share that world with. And unfortunately, since the lockdown occurred, then the world that we live in has changed very dramatically. And I'm assuming that that is going to change people's values and beliefs around money and what they're trying to achieve going forwards. And even the people that we share that world with has had to change dramatically over the last 3 months or so. One example of coaching is what we call, or what it is called, sorry, the character diamond. And bear with me because this one's a little bit left field. And I came across it. It's used in movies and it's used in script writing and book writing to define the key characteristics of any character involved. And it has 4 key areas. On the top, we have North Star. On the bottom, we have kryptonite. On the one side, we have the hill that you're prepared to die on. And on the other side, we have flaws and masks. So let's look at them one by one. We have North Star. That's what is the character's superpower? What is it that makes them different than everybody else? In essence, what makes you you as an individual? On the opposite side of that, we have kryptonite. It's normally the thing that gets in people's way, and often it's the opposite to the North Star. We then have the hill that you're prepared to die on. It's usually somebody's number one value. And it's what they stand for no matter what. It's normally an immovable thing. There's no way that you're going to shift this person away from this value or this belief. On the opposite side of that, you have the flaws and the masks. We all do things that are slightly irrational. We have views and beliefs that might be slightly irrational. So it's what lies do we tell ourselves, if you like, to cover up our own vulnerabilities and insecurities. And it dawned on me that if the character diamond works for movies, then could we utilize it as part of financial planning? But obviously, rather than looking at the whole character, what if we just limited it to our financial values, beliefs, and attitudes? In other words, what if we just looked at our character in relation to money? And so I embarked on testing this out on a number of clients, and the results were fantastic. This is a real life example. I've changed the names. We've got Harry and Sally. And Harry is now 77, and he's always enjoyed a good job and income. But he was a baby boomer. He was a war baby. And so he's always been very measured in his expenditure. Or they've both been very measured in their expenditure, and they've lived below their means. And then actually getting value for money is a key thing for them in everything that they do. They actually get a dopamine hit for getting value for money. But on the opposite side of that, we have this kryptonite, where they've missed out on some things and actually experienced discomfort. When I was talking to Harry and Sally about this, Sally got it more than Harry did. Harry said, I don't experience discomfort. And I said, hang on a minute, Harry, you've just told me that you will get up at 3 a.m. in the morning in order to get a cheaper flight than actually get up at a nice leisurely 8 o'clock. That to me is discomfort. You've just told me that you will fly long haul in economy, even though you can actually afford to fly business class. The retort to that, by the way, is, no, I've moved now, I've changed, I'm now doing premium economy. But the same thing still applies. The hill that they're both prepared to die on was the financial security for them and their family. But interestingly, they'd hit this goal literally decades ago. And because they were measured in their expenditure, they're actually still in the saving mode. They're actually still spending less than their income that's coming in, and the portfolio is still accumulating. And then some of the flaws and masks is the sheer amount of time and energy that it takes them to hunt out that value for money sometimes. Sometimes that equation actually doesn't make sense. And that even though they know that they're financially secure, even though they've got more money than they'll ever spend, even though they've lived through countless recessions and market crashes, when markets fall significantly, as they just have with COVID, then they instantly feel stressed and insecure. And so it's a fantastic way of coaching out of people what their values and beliefs are about money. And then we need to decide how we deal with that. And I really believe that it's important that families as a group, as individuals as well, talk about money, that they understand what it means for them and how they're going to deal with it. And we're brought up to believe that we shouldn't talk about religion, politics, sex, or money at the dinner table. I'm not sure about the first three, but I certainly believe that as families, we should talk way more about money than we do at the moment. One of the most important questions to try and identify, what we try to identify with Harry and Sally, is what is the purpose of the money? It's a really simple question, but the answers can be quite complex and quite difficult to ascertain. And so I wanted to share a few examples of how we've helped clients do something differently with their money. We've got a client who's an amateur racing driver, and I went to watch him race at Alton Park last year, and he was pointed to his motorhome. He said, "Colin, that's down to you, that is." I said, "What do you mean?" He said, "Well, you explained that I have actually reached financial security, that I do have more money than I'm going to spend. And I was previously staying in bed and breakfasts when I was going on racetracks. I've now realised that actually I can afford the motorhome, which is fantastic because I can relax in between races, don't have to stress about where I'm staying and what I'm booking. And it's actually made a real difference. And it was fantastic that he realised that that was as a result of the financial coaching that we've been giving. Have another client where they have what I call a disassociated relationship with their portfolio. And a lot of people fall into this category. They think of their income, they think of their cash reserves, and then the portfolio is somewhere over here to one side. And so it didn't matter if the portfolio was going up, if the cash balances were going down, that was how they judged whether they should spend more money or not. And so in this example, we decided that actually then, let's create more money. I mean, they'd filled out an expenditure questionnaire and the income was matching the expenditure. But we thought, well, what if we just provided more income from the portfolio? Because there's a different emotional relationship with having more money coming into the bank account than going out and seeing cash reserves going up. You're far more likely to spend in that example. And in this case, the individual then spent money on better timed flights, parking closer to the airport, a little bit extra even on clothes and entertaining, and also on supporting various different family members. And again, it's made a real difference to them and their family. We have many people, when they've spoken to their families about money, they've realised that funding of pensions for the current generation is incredibly difficult. They didn't have the final salary pension schemes that many of our clients have benefited from. They didn't have the fantastic stock market growth. And just buying a house is an incredibly financially draining issue for many. And so we've now got many clients that are paying directly into their children's pensions, getting inheritance tax relief on those contributions, getting income tax relief on those contributions, and allowing their children to have their own financial confidence going forwards, that they can retire with a reasonable amount of money at a reasonable age. One of my favourites recently, and this is a family that I absolutely love to work with, they sat down with their children, they put all the finances on the table. We asked the children to complete questionnaires about their own financial positions and about what their aspirations and challenges are going forwards. And the two children were both in their 30s, both living in London in one-bed flats that would cost around about 500,000, which is incredible to think about. And both of them were engaged, and their number one priority personally going forwards was to have children, which was fantastic because it fitted in exactly with their mum and dad's number one priorities because they couldn't wait to have grandchildren. It turned out that from the children's perspective, they simply couldn't afford a property big enough in London to store the children. If you'll pardon the pun, they had enough room to make the baby, they didn't have enough room to keep the baby. And so as a result of discussions with mum and dad and various different options, they've now been given an advance inheritance that will then allow them to buy that extra property, to buy that extra space, so that actually they can start a family earlier. Now, if they'd had to wait, they could have fit into all sorts of problems from infertility and everything else that goes along with it. And so that's a fantastic example of families really coming together. And of course, the first reaction from the children, as always is the case, is, no, mum and dad, go and spend it on yourselves. You go and enjoy it. We'll take care of ourselves. And yet, coming back to Harry and Sally, they hadn't realised that they'd already reached that level of financial security. They were already spending everything that they wanted to spend. So the question being, what is the purpose of the money? The purpose of the money in that case was to help the family achieve their goals and feel financially secure. We've got many family members that are embarking on careers for love, or sorry, the opposite way around. They're in careers for the money, not for the love of it. And actually through financial support from the parents, then they were able to change careers, maybe even reduce hours, so that their life satisfaction was so much massively greater. There's the other example where perhaps both parents are working because they have to, because they don't feel as though they've got any other financial choice. And yet, ideally, especially in the early years, they would love for one parent to take the time out. And again, by families talking about money, by putting money to the best use, discovering its purpose, we're able to help. And then, of course, we have some clients where the children have already got enough money, they've got too much money, and so one of the things that we're able to help and coach with is charitable giving, both during lifetime and on death. What we're talking about here really is values around money, and values to us are absolutely everything. And values as a business should not be something that is on a reception wall. Values as a business should be something that's lived by every single day by every single member of the team. And it should be obvious to our clients, to everybody that we work with, what those values are, almost without them even knowing. And when you've got a clear sense of what your values are, then we should also have a clear sense of what our purpose is as a business. And I said that, identifying the purpose of money is really important for clients. Knowing what the purpose of the business is really important for us, our clients, and our team. And our purpose is really simple. It's to make people's lives better. And our culture has really stood us in good stead over the difficult period during lockdown. And if during every single interaction with our clients, we're asking ourselves a question, is this making their life better? Yes or no? If it's yes, it's a great thing to pursue. If it's a no, let's not bother. So that is really key, and everyone on the team has that as a very, very clear purpose. And it's when you bring values and purpose together that you can really start to make a difference. And so we've got 4 values: integrity, excellence, simplicity, and growth. So if we look at growth, growth means to us never stop learning. If we've got team members that are learning and growing all the time, they're getting more knowledgeable, more experienced, they're getting better at their jobs, then they're going to provide a better service for our clients. If, as a business, we're continually growing, we're going to be able to retain the best staff and attract really great new ones as well. We've got integrity. Now, obviously, we're in financial services. There's a level of integrity which is, again, just a hygiene factor. But for us, it's so much more than that. Integrity is always, and the key being on the word always, doing the right thing. And we have values of the quarter. And this quarter, one of our values is integrity. And so we ask the team to nominate integrity wherever they see it in any individual. And so far this quarter, we've had 32 integrity nominations. Now, just a few weeks ago, I can give you an example of integrity in action. I got a phone call at about 2 o'clock from a client manager, one of our back office staff, who said that they'd done a transaction for a client. And whilst they'd followed every single procedure, whilst it had been done correct by the book, that they didn't think it was excellence, that they thought that we could have done better as a team. And in this case, it resulted in a loss for the client. Now, that's integrity in itself. The fact that that team member felt that we had the culture that they could phone up and say, I think we could have done this better, and not worry about them getting into trouble, and not just think, oh, I'll just leave it, I'll just sweep it under the table, no one's ever going to notice. The client wasn't complaining and never was going to complain. So I instantly got on the phone to Debbie Dukes, our head of client care. We discussed the case with Debbie, and within half an hour, we decided that yes, it could have been done better. The next stage then was to calculate the compensation. In this case, it's about £10,000. And then the third stage, obviously, is to communicate that to the client, who was then delighted. The fourth stage is then to work out, what can we learn about this? What can we do better? And so every time anything like this occurs, we share it with the whole team. We let them know what's happened so that we can learn from it and improve processes and systems if need be. And so we always will do the right thing. Integrity is of absolutely critical importance to us. And it obviously goes hand in hand with excellence. I mentioned that we didn't do an excellent job. We followed procedures, we did an okay job, but it wasn't excellent, so we compensated. Last quarter, excellence was our theme. And I think we had 89 staff members at the time, and so we asked for 89 nominations of excellence. We actually had 139. Every one of those was then assessed by the senior team, And we then distilled it down to 3 winners who were awarded prizes at the end of it. And the whole purpose of the exercise is the more that you recognize excellence in each other, the more that you learn to be excellent. And so the more that we focus on our values, the more that we encourage people to display those values going forwards. We work in one of the most complex industries and one of the most highly regulated industries that there is. And so having simplicity as a value is a real challenge, but it's our job to simplify the complex, to make our reports as easy to read as possible, to make the way that we deliver information as understandable as possible. And one of the documents that I'm weirdly proud of is our retail client agreement. It's very simple to read, and the feedback that I had from a client was it's one of the best documents that they've ever seen, which is fantastic feedback to get from what is essentially a really boring, dull compliance document. And as I said, our values aren't just on a reception wall. Our values are our stars to steer by. We use them every day as a senior team and as a team as a whole to make decisions about the things that we do or don't do. If a new project that we're planning fits in with our values and fits in with our purpose, then we will go ahead and do it. If it doesn't, we'll stop it. Example of that last year is that there was a new division, if you like, that we could have launched, and we looked at it, and whilst it would be profitable, we couldn't at that stage see how it would make people's lives better, and so we ditched it. I say we ditched it, we've actually paused it, because we're looking at it and say, okay, how can we tweak that so that it does? How can we tweak it so that in every essence it still fits in with our values and purpose? And coming back to making people's lives better, making wealthy people wealthier is part of what we do, but it's not our purpose. And the reason being that it doesn't make people's lives better. If I could magically, which I'd love to do by the way, add a 0 onto the end of every single client's portfolio tomorrow, would it achieve anything? On paper, yes. In reality, no. Because unless people do something differently with that money to benefit themselves, their families, or the communities, it doesn't achieve anything. However, if we can help wealthy people gain confidence and clarity around their money, confidence and clarity of critical importance, and if that then leads to them making better financial decisions, in other words, doing something differently than they were doing before they interacted with us, then, and if that leads to them making their families and their lives and their communities' lives better, then that's a purpose. And we also have our client charter, which is very simple and straightforward, and that actually forms part of our retail client agreement that I mentioned before. Now, we like to think that we know our clients very well. Our first client 25 years ago is still a client today. However, we obviously see things from our eyes, from our viewpoint. And we thought it'd be really useful to get together a group of clients that we call a client advisory board that will meet several times a year to discuss a limited number of questions about the services that we currently provide and about things that we might be thinking about in the future. And a great example of how the Client Advisory Board is working is if we look at this chart here, on the vertical axis, we get perceived value going from low to high. On the horizontal axis, we go cost going low to high. And clearly, if there's something that's high cost for the business to provide, you're paying our fees after all, and is low value to the clients, we shouldn't be doing it. If something is low cost to the business and high value to the clients, then we should be doing more of it. So that's a great simple way of taking things out to that client advisory board and saying, where does this service fit here? Where does this service fit there? And that also then includes new services and projects that we'd like to embark upon, that before we go and invest time and money into it, then surely let's find out what clients think and how they think it should be tweaked before we begin. And when we put it together, we realized that it was important to have an independent facilitator. I was originally going to facilitate the meetings, and then it dawned on me that if, for example, a client said, well, I believe that Jones & Co down the road do inheritance tax planning better than you, my response would be to be defensive. Maybe to say, oh no, let me tell you all the reasons why we do it better than them. Andrew Carroll, who we found to lead the board, is a fantastic facilitator, and his response is more likely to be, that's fascinating, tell me more. And so far, we've had a couple of meetings, we've got another one coming up, and it's working really, really, really well. to find out exactly what our clients want and to keep us on track. And we believe that businesses as a whole have often got their priorities the wrong way around. When we run our business, we believe in putting our team first, putting the staff first, because if we do that, if we have a group of motivated, empowered individuals, then they are going to put our clients first and they're going to provide a fantastic service for you, our clients. And ultimately, that will result in long-term shareholder value. When you look at that, that's, to me, is common sense. It's the way it should always be done. And yet when you look at how things actually work in the real world, then when we're buying shares in an individual company, what we want to buy is the share that's going to go up by the most in the shortest possible space of time. So we put shareholder value first. Underneath that, that business then might put their clients as a secondary value. And ultimately, often the team sits at the bottom. And one, you can argue the pros and cons of this, but Amazon could perhaps, certainly with some of their recent practices, fit into that box quite nicely. And one of the reasons for supporting the team is that we believe that if we have a group of happy campers, then they're going to be far more productive than if we didn't. And I've always had a belief that under normal circumstances, obviously, we spend more time in our offices than we do in our own homes. We spend more time with our team members than we do with our families and friends. And so surely it's our responsibility as employers to make that as rewarding and as fun as possible, while still making sure that we have a highly productive team. And that has really, really kept us in good stead as we've moved, having 90 people working from home and hardly seeing each other apart from video calls for the last 3 months or so. And I'd hate to think about how difficult it would have been to run this business if we hadn't had that strong culture in place. And we've done 2 happiness surveys. This is the first one. The second one, we're just getting the results back at the moment, where we send out a questionnaire to all the team, 5 simple questions to answer, followed by 3 words that they use to describe how they're feeling at the moment. And this is a word cloud of those words. This was about halfway through lockdown. And it was fantastic to see that the number 1 word is supported. And you've got grateful and happy and proud and lucky and motivated. And I don't think there are many firms out there now that if they were surveying their team about how they're feeling under lockdown, would be coming back with such positive feedback. We also believe in supporting the world in general, supporting our communities through philanthropy and through charitable giving. And so we launched the Equilibrium Foundation 10 years ago with a target of raising 250,000. And this year we'll surpass the 400,000 mark, which is absolutely superb. So thank you to all of our client staff and all the Equilibrium team for an amazing achievement. We're in the philanthropic top 30 companies to work for in the UK, which is an achievement of which I'm incredibly proud. We also encourage the staff to go out in the community and do volunteer days. We think it's great for the community, it's great for them, it builds teamwork. And we have a Give As You Earn programme, and literally just this week, we received the diamond status for the Payroll Giving Award for the number of team members that actually donate to the foundation on a monthly basis. I recently learned the difference between charitable giving and philanthropy. Charitable giving often being smaller amounts, ad hoc heartstring pulls that you give to a variety of charities. It's what most of us do each and every day. Philanthropy, on the other hand, is trying to solve a specific problem, either through donation of time, money, or resources. One of the things that we're passionate about is financial literacy in the UK is incredibly poor. And if you want to solve financial literacy in adults, you need to start with children. And so we've launched an education program for key stage 1 and 2 children to build their financial literacy knowledge. And we've literally reached thousands of children and dozens of schools. And the feedback from both the schools and the children has been absolutely fantastic. And we now look at repurposing this for maybe 13 and 14-year-olds that are also struggling or struggling even more. So one's preventative, one might be a bit of cure. And when we're investing in businesses, we also want to invest in businesses that think like us. And the Companies Act, when you look at it, is actually quite shocking for some people because it actually requires directors to put shareholders' profits above all other interests. So profits first, everything else second, third, fourth, and fifth. And there's a campaign at the moment to change that, to putting social, environmental, and employee interests on equal footing as shareholders. And we've signed up to that campaign, and the email address is there if you want to have a look at it. And I think COVID has magnified many themes out there at the moment. And the change that maybe was going to happen over a decade might now just happen over the next couple of years. And big business has got some very bad reputational damage over the last few years. And I think there is a movement that's beginning and is escalating to change that. And for us, it's all about putting you first and not your numbers. And we've signed up for the initiative Financial Wellbeing. It's an organization that's sole purpose is to help identify the relationship between money and happiness and how we can encourage our clients to use their money for greater levels of happiness rather than greater levels of stress, because money, regardless of the amount you've got, often brings stress for many individuals. We're also members of Humans Under Management, and the clue is in the title with that one. It's not assets under management, it's humans. It's how we look after people that's the most important thing, not necessarily what we do for them from a numerical point of view. And we want companies to change. We want companies to use their powers for good, not evil. We don't believe that doing the right thing has to hurt profits or shareholder value. Far from it. In the long term, doing the right thing will add profits and shareholder value. And we went to an organization called Ripples for Change. It's part of the Robert F. Kennedy Human Rights International organization. And one of the key questions I had at the start is, why is a human rights organization getting involved in business? Why are they getting involved in companies? And it's clearly because companies now have actually become bigger than countries. And yet there is no human rights initiative. There is no human rights across the board for all companies. We've also signed up to the United Nations Principles for Responsible Investing, and we've asked all of the funds that we invest in to also sign up for that, which then involves an annual assessment each year to make sure that you're qualifying. So hopefully that's giving you a flavour of where we've been and where we're at the moment. So where are we heading? Well, we've got what we call our BHAG, a big, hairy, audacious goal. And it's very simple. It's to get to 4 billion of assets under management. We were at 1 billion, slipped back a little bit, almost back there again now. And I'll come on to why 4 billion in a minute. Importantly, we want to look after 4,000 clients. We currently look after about 1,200. We want to look after as many people as we possibly can because we want to make people's lives better as frequently as we can. I said we raised 400,000 for the foundation so far. We'd love to raise 4 million over the next 8 years or so. And that will see the company then get to a 40 million turnover. But if we're going to achieve that, the only way we can achieve that is by delivering excellence to our clients at all times across the board in everything that we do. Because we realized that our marketing, you see that bottom line there, is actually going to be fixed at a certain level. So that as we grow, we're not expecting to win anymore as a result of marketing activities. There's only so many presentations like this that we can do. And that actually, as an importance to the business, marketing will decline as other areas get bigger. And at the moment, 1/3 of our business comes through referrals, recommendations from our existing clients. 1/3 comes from our existing clients contributing or investing more into their portfolios, and 1/3 from marketing. What we need to do is to maintain that referral rate. We need to make sure that if we get a 5% referral rate from every 100 clients we get, or we have, they will refer 5 friends. That we maintain that so that that actually grows on a nice curve. And we can only do that if we're providing an excellent level of service and results and delivering what we've promised to do. We've currently got 1/3 coming from contributions. So again, the more money that we've got under management, the more we'd expect existing clients to contribute. But you're only going to do that as a client if we're delivering excellence, if we're delivering that across the board and delivering on the service and the results that we've promised. So I often believe that some businesses are in danger of hitting the target but missing the point. And so why 4 billion is one question, and what happens after that? So let me tell you about our thinking over the last few years. One of the key questions for shareholders in a business is, when do you sell it? When do you realize that capital value? And for many people, the answer is when the value is enough. And for us, that value was enough in 2017. From the equity partner's point of view, we could have sold the business, never worked a day in our lives, and we would have been financially very secure and very happy. And so we embarked on a process to sell the business. We engaged with a corporate finance firm down in London called IMAS, and a fantastic gentleman down there called Fred Hanson. And we paid them their fees. They started to package us up for sale. They started to research who the likely buyers would be. And this next slide is a list of all of the different companies that would have been interested in buying us. And unfortunately, we didn't have the original slide. You'll see in blue there all of my colleague Debbie Jukes' notes about the various different firms. And what dawned on us when we looked at that list is that we were winning clients from almost all of that list, and they weren't winning any clients from us at all. We realized that if our clients wanted to be with these bigger firms, they'd already be with these bigger firms. So that didn't seem to fit. We believed that a lot of what we did, both culturally and professionally, was much better than these firms. And we realized that the size that we were, that we would be assimilated. Equilibrium would cease to exist as a firm. Our processes and culture would cease to exist. And we realized that our staff would be exterminated. Probably 70% of our staff would lose their jobs. And as I said before, that if our clients wanted to be with a Brewin Dolphin, Close Brothers, Brown Shipley, or anybody else, they would already be there. So it seemed to be that we would be selling them under the bus. So our staff would be unhappy. Sure, we've hit the target of financial security for ourselves, but we start off with looking after the team as number one, and now we've just ditched them at the final hurdle. We realized that our clients would be unhappy. As I said, if they want to be with those firms, they'd already be with those firms. And it's the shareholders that would be jumping up and down for glee. But it just didn't seem to fit. Because if you get it wrong, to me, selling a business is like a bereavement. You give up what you love in exchange for a big check. And so we abandoned the project. We just literally ceased. We said, it doesn't fit in with our values and our purpose. And that left us with a bit of a problem, because you go, okay, what do I do next? And so we came up with a new plan, which was to get to 4 billion. And the growth that that requires is nothing more than continuing to do the same curve that we've already done. It's just that as you get bigger, things compound quicker. So sure, as I said, we've got to maintain all that excellence. We've got to maintain those results. And if we can do that, still focusing on the areas where we play, which is the SK, WA and CH postcodes, and yes, we do have clients from further afield now, but that's our core market, then we would become too big to assimilate. Somebody buying us would not assimilate us. They would retain the brand and then maybe think about, oh, we can then take it into London, we can take it into Leeds, we can expand it nationally, something that we haven't got the inclination personally to do. So what we wanted to do was to change shareholders. So we realized that we could do that with a strategic shareholder. That is possible. But then we thought, are they still likely to put shareholders first rather than a team first? So is that actually the ideal? And occasionally I come up with the odd crazy idea. And the crazy idea in this case was that if we manage £1 billion worth of assets and the business is worth a small percentage of that, then actually we are discretionary managers, we run funds, we could buy ourselves and we would just pop into the fund. Now, of course, there's a really big problem with that because I'd go to jail. And as I don't want to go to jail, I had to rethink the idea. And rethinking the idea was to say, well, okay, but what if rather than just doing it for clients without telling them, what if you went out to clients and say, would you like to buy a share in the business? And so I went out and I spoke to clients. And every single client that I spoke to said, absolutely, that they know the business very well, that they would rather actually pay a few small percentage points to stay with the firm than they would having to go and find a new firm. I met with numerous lawyers to find out if it was going to be a problem. And they said, no, there's a couple of things that you need to overcome, but there's no real reason why you can't do it. Spoke to a number of accountants. And they said, no, there's no reason why you can't do that either. And so it's been developed from a crazy idea into a cunning plan. And that is ultimately the aim that we would like to do, is to have the business majority owned by clients. Because to us, that would be hitting the target and the point. And, we would still stay on as minority shareholders and chairmen, non-exec roles. But ultimately, the idea of being able to make sure that the business can continue with the same thought process, the same values, the same culture, the same results for many, many decades is what we want the elegant exit to look like, regardless of how that comes about. Now, hopefully, I've given you a little bit of insight into who we are. I mentioned that we've got some more live stream events coming up, and our live stream events and real events are designed to act as a shop window. It's designed to allow you to get a feel for who we are, what we do, and why we do it. Otherwise, I'm told that clients feel very uncomfortable coming into a financial advisor's firm, first of all, and having to give all of their financial information, tell them all about their financial secrets, their desires, their fears, and they don't really know anything about the firm. So what we want to do is to make sure that you know as much about us as possible before you come on board. One of the things that is another key issue for us, and it's within our guide to fees, is that we don't like bias at all. Incentives are a very bad thing, and there's been a lot in the press about sales incentives of late. None of our advisors are targeted based upon winning new clients. None of them are financially awarded for winning new clients. We have business targets overall, and that's the same across the board, whether you're an advisor or whether you're working in finance. It doesn't make any difference. So you can be absolutely assured that if you're in discussions with an advisor, they will have your best interests at heart and not their own. One of the feedback we got from the first client advisory board is that during that onboarding process, and we'd have 3 meetings as a minimum with prospective new clients to get to know each other very well, that we will invest as much time as you need during that process. And the client advisory board picked up on the fact that one of the reasons why they came on board is that we had the patience to get to know them well, and we had the understanding of their own individual circumstances and picked that up very quickly. During those discussions, we want to make sure that we will be a good fit for each other. We're in the lucky position now that we don't have to take on board every client. If we're going to be working with you for a lifetime, we want to make sure that that is going to be a happy and profitable relationship for both sides. And so if we don't think it's a good fit, we'll tell you, it's never a problem. And if it's going to be profitable for both sides, we have to make sure that we can add enough value, both initially and ongoing, to that relationship, so that the value add is significantly greater than any fees that we charge. And talking about fees, we have a number of guiding principles. Firstly, no bias whatsoever. It doesn't matter what we recommend, what the strategy is, or anything else, there will be no bias in relation to our fee structure. We have transparency. Obviously, that we will be very clear, and there's a regulatory requirement about this in terms of what we charge, but we're far more transparent than that. We absolutely spell it out in pounds and pence and make it really clear every penny that we will receive. And we will be consistently fair. If we have same clients with the same circumstances, nobody will be charged anything differently. I've already touched on added value as being important. But most importantly is that we will keep you in control of those fees. So what do we mean by you being in control? Well, we have a unique fee guarantee, and I don't believe that there is any firm of our size, or pretty much any firm out there, offering something as clear as this. In that, if at the end of the year working with us, if you don't believe that we've lived by our own values, delivered what we've promised, then we will refund that fee for you for that year. And that's every year that you're working with us. And the reason why we do that is to give you the confidence in advance of the services that we provide, and to make sure that we stay on our toes. Because if we're constantly thinking about how can we add value, how can we make your life better, because we know that we've got to have that conversation, then that conversation should be a very easy and simple one every single year. It's important for us as a business that we keep score to stay on track. So we enter a variety of awards. And the reason why we enter the awards is that we actually learn from the award entry process, and that surely to win an award, you have to be demonstrating excellence in some form or other. So if we stop winning awards, then that's going to be a clear sign to us that something's gone slightly awry. And we hope that we've already won lots of awards this year, because a lot of the award dinners have now been pushed back. I think we're shortlisted at the moment for something like 8 or 9 awards. So time will tell how they will pan out. We also have the CX Awards. This is a survey that goes out every 2 years to all of our clients. It's independently hosted. And Neil Craig, who runs that survey, and the last one, we scored 9.12 out of 10. Now, I don't know about you, but I don't really give 10s on surveys. 9 is normally the maximum that I can give, because surely 10's, not possible to achieve. But Neil said that in his experience of running those surveys for more than 10 years, the results are unprecedented and placed at the very top of the client experience tree. Now, when I say keep on score, stay on track, if that dropped to 8 in a couple of years' time, that might be a good score for some firms. 8 out of 10 is still really good, but it would be a real warning sign to us that somehow we're slipping, that somehow we're not getting it right. Now, we believe that in difficult times, you can't over-communicate, and it's fair to say that the last few months have been difficult times. And each star on this FTSE graph here is a communication point that we've sent out. And what you can see is that as things get more difficult, then we communicate more and more and more. And there's a mixture of communications. There's live stream events like the one that we're doing today. There will be videos and written market updates that we will send out. And then there's other blogs and other videos, which are more about how we're actually thinking. So we're trying to communicate what's our investment thoughts, what's our thoughts on the world in general, so not investment related. There's been quite a few videos that are on our website that you might want to take a look at that are just our views on COVID and how we're all reacting to it, for example. And then we have our Equinox magazine that goes out every 6 months, which is well worth a read. It's got all of our investment performance in there and a big section of investment commentary, but hopefully other interesting articles for you as well. So if you are interested in finding out more, why not attend one of those future events? Simply Google us. We've been around long enough now that there's lots of things out there on the internet. And or if you'd like to, please do get in touch, and you're more than welcome to talk to some of our existing clients. So what next? Well, hopefully today I've just given you an initial flavour for who we are, what we stand for, and what we aim to do as a company. And one of my objectives was to hopefully prompt that question for you is, do we sound like the kind of people, the kind of firm that you would like to work with? Do you think that we might be able to help to make your life better? Do you think that we might be able to help make your portfolio better? And I suppose the simple question, would you like to join the Equilibrium community? Because if you're the right fit for us, then it would be fantastic to have you on board. Well, I think bang on the hour, although I did forget to say it was going to be an hour at the start. My apologies there. We are pretty much bang on the hour. And so we're now going to move over to question time. I also forgot at the beginning, my second apology, to explain that we will be taking questions. There is a question box on your computers, if you can find it, depending upon the device. It's located in different places. Hopefully we've had some coming through as we've been going through the presentation. And I'm now going to be joined by my colleague, Ben Rogers, who's going to moderate some of those questions, hopefully. So Ben, do we have you by the magic of technology?
Yes, hopefully you do. Thank you, Colin. Firstly, I'd just like to say, as a member of the team at Equilibrium, I always find this presentation, I've seen it a few times now, we presented to staff and in previous live stream events, and I always appreciate the transparency of how we've got to where we are and where we're heading going forwards. We've had 1 or 2 questions through. As Colin said, you can find the Q&A button normally at the bottom of the screen. However, I'm reliably informed that Apple products, it can be found at the top. The first question we've had came from Mary, and it's regarding your comment on the fee guarantees. She's asked, would that not mean that you'll be refunding a lot of fees now, given recent investment and performance and how it's been impacted by coronavirus?
Okay, thanks, Mary. That's an awesome question. No is the simple answer. We haven't had one single request for a fee refund. as a result of that, or in fact during this time period. One of the presentations that we've got for existing clients is managing risk, meeting expectations. We also have what we call the investor safety briefing, and every new client coming on board, we explain very clearly what the parameters are for their portfolios. We explain how frequently they are going to lose money, because there's that saying in industry, past performance is no guide to future performance. Your investments can go down as well as up. No, your investments will go down as well as up. Not can, will. And so it's important that clients understand the levels that those drops might be. And it's important that clients understand that even with those drops, they still have a robust financial plan, and that it shouldn't affect their lives in the short term or the long term one iota. And so one of the things that we've been doing with clients during this period is to revisit those financial plans, to look back at them, and to make sure that everything's still fine, to make sure that they can continue with life as normal. And you know, in 99.9% of cases, that's still the case. And so no, we don't expect to give any fee refunds at all throughout this period.
Brilliant, thank you. The next question came from Peter, who says that I look after my own investment portfolio and I'm comfortable doing so. Can I still receive financial planning or tax planning advice from Equilibrium without necessarily having to invest with yourselves?
Okay, thank you for that one. One of the challenges with having a portfolio that's disconnected to the financial planning is that the key element in any financial plan is what investment return are you going to achieve. And so how do I know what number to plug into that financial plan without being able to manage and influence the portfolio? Another challenge again is in relation to the tax planning, and that it's quite difficult to do that remotely, if you like, when individuals are making their own trading decisions, for example, which could have capital gains tax implications, could have income tax implications if they're buying a high yield investment. So that is actually very difficult to separate out. What we do have is two standalone modules. We have an inheritance tax and intergenerational planning module, which can be purchased as a standalone service. And that doesn't matter then whether you've got a buy-to-let portfolio, whether you're managing your own money, and because most people haven't got the skills or the technical knowledge to deal with those two issues. And so we felt that was valuable to have as a standalone, and people can carry on managing their own money. We also have a business owner strategy service whereby we can put in place the building blocks from a tax planning perspective and a portfolio planning perspective that people need well in advance of a business sale, so that hopefully when the sale goes through, they've already done all of the planning that's required. So those are the two separate, but otherwise we love to be a one-stop shop for our clients.
Brilliant, thank you very much. The next question we've got here is from Richard. At the point of considering selling the company, did you consider staff becoming shareholders, sharing profits and eventually taking control rather than clients, or are staff already shareholders?
So we've got 5 equity partners at the moment, some of which, or majority of which, have bought in at a discounted rate. The challenge is within our industry is the level of indebtedness that I believe that would bring on to the company when you're looking at employee ownership. So unless we're going to be giving the company away, which we'd rather not do, then we don't think that employee ownership works. We're currently an LLP as well, a limited liability partnership rather than a limited company, which makes it more difficult for staff to be shareholders. We are looking over the next few years about moving to limited company status, and then we are going to look at various different employee share schemes and employee incentive schemes. So there will be an element of staff membership, I'm sure, over the years ahead. But I think for our particular company and structure, then that actually wouldn't work, because even if we were happy with the level of indebtedness, I'm not sure that given the regulatory environment that we work in, that we'd actually be able to make that work.
Brilliant, thank you. The next question is from Andrew. what is your track record on achieving inflation plus 5%? So this is alluding to the investment target that you spoke about earlier in today's presentation.
Okay, great question, Andrew. I love tough ones. So what's our track record on achieving 5% above inflation? As I said, it's a rolling 5-year target. Some 5 years will be much less, some 5 years will be much more. So obviously 5 years ending right now, I think it's more like 1 or 2% if we're lucky. If we look at, though, all of our rolling 5-year periods over all of the time periods that we've been managing money, and we do that on a monthly basis. So I think there's now about 150 5-year time periods that we've got. And for our balanced portfolio, the last time I looked, then on 94% of those 5-year periods, we'd achieved at least 3% above inflation. So at least 5% returns. And it's that 5% return that we use in our financial planning for clients, so that we've got a margin for error, so that they can be confident and have clarity on their decisions going forward. I couldn't tell you the exact number on the 7%, but I will get back to you. I'm guessing it's something like 70 or 80.
Thank you for that. This next question comes from Brendan. If we came on board as clients, would we be allocated to one specific advisor, or would there be more of a team approach?
Oh, I think I can manage that question, Ben, but you were... So I think the question was,
sorry.
If you come on board as a client, would you be allocated one advisor, or would it be a more team approach? I think was the question. So that's what I'm going to answer anyway. You would be allocated one advisor. Every advisor, though, is supported by what we call a client manager, what in the industry is often called a power planner. And the client manager will sit alongside the advisor in every single meeting. They will take all of the minutes of the meeting, and generally they will be responsible for following up the actions that come out of it. So the advisor's role is to create the strategy, to give the advice, to deliver the meetings, and the client manager's role is to then deliver on that strategy. For some clients, you might have a team of 2 client managers that are allocated, but that way also you'll always be able to get in touch with somebody as an individual. And also our investment team are very visible. We'll often pop into client meetings and are happy to take client queries direct as well. So whilst there isn't an individual within the investment team that's actually allocated, they are available, but it's always a team of at least 2, often a team of 3 that will be looking after you.
Thank you for that. That was the right question, and I apologise for the slight break up there. We've got 1 or 2 questions left. The next question came from Simon. Do you offer investment-only services for those who don't require financial planning? So almost a bit of a flip from the previous question.
Yeah, so Simon, the investment-only option was one of the things that we were discussing, and I mentioned earlier in the presentation about a project that would have been very profitable, but we dismissed it because in and of itself, it doesn't make people's lives better, and that was a project. And you could argue that, managing risk well and delivering good investment returns does make people's lives better. But as I said, directly it doesn't. If we just make more money for people, they've just got more money, we haven't achieved anything. That's a project that we're currently looking at the moment to see how we can actually tweak it, to see if we can operate that as a separate service, what that would look like, what the cost would be, and what actually advice we can still pin on the round side, whether that's ad hoc or a different kind of ongoing advice. So at the moment, it's a firm no. In the future, hopefully, it will be a firm yes.
Brilliant, thank you. And we've just got one last question here, which comes from Anonymous, which is, how do you charge your fees, and would you charge extra for adding in more money or making changes to my portfolio?
So how do we charge our fees, and would you charge in extra for adding to it? We charge them frequently and often. No, I'm only kidding. So if you're coming aboard as a new client, there are a number of stages. We have our initial planning stage, which is 3 months where we'll be making all the recommendations. and structuring the portfolio and creating the financial plan and everything else that goes along with it. And so we asked to be paid for those 3 months up front. If at the end of those 3 months you decide it's not the right fit, maybe we thought it was the right fit during initial discussions, but for some reason you've changed your mind, we've changed our mind, then we can always part company at that stage. After that, then we have an implementation fee. So if you want to go ahead, then we'll charge for onboarding you as a new client and implementing those recommendations. And then after that, we have an ongoing annual percentage fee that varies depending upon the size of the portfolio, but our fee at the top end, including the investment management and the financial planning, tax planning, and everything else across the two companies equates to 1.5%. I think part of the question is, do we then charge for adding more money in? Then no, we don't. It's about onboarding you as a client and then implementing it. And if you want to add in more money at this stage, there are no additional implementation or planning fee for that. It would just be the ongoing fees from the day that extra investment is made.
All right, thank you for that, Colin. That looks to be all the questions we've had so far. And so thank you very much for taking the time to answer those.
Fantastic. Thanks, Ben. Well, that brings us to the end of today's event. I do hope that you've found it to be interesting. We will be getting in touch to see if we can perhaps sit down for a virtual cup of coffee, perhaps have a chat and get to know you a little better. Otherwise, please do, as I said, have a look on the videos. Please do attend another event, and we look forward to meeting you in the real world soon.